Hello, everybody. It's Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, also known by many of you as Mr. Valuation. This is the second video that I've done on banks that are listed in that are part of the S&P 500. In my last video, I covered the big money center banks like Citigroup and Bank of America, etc. In this particular video, I'm going to look at money center banks. So let's go ahead and make sure you're with me on this. I have the S&P 500 up here as it's listed on FastGraphs. So what I've got here, this is the GIC sub-industry that I've got them organized by. And you can see diversified banks. There were about a half a dozen, I think 5 of them actually all total that I did last week. Well, now what we're going to be looking at are the regional banks that are part of the S&P 500. Now, frankly, as a result of the Great Recession, that happened in obviously 08 and 09, which was primarily instigated by loose financial lending and participation by especially some of the money center banks in getting involved in these, collateralized mortgage obligations, even collateralized mortgage obligations squared. In other words, they were using an awful lot of leverage and loaning money, very recklessly and loosely. Well, the regional banks, one thing I like about the regional banks, the smaller banks that, function in certain regions of the country, they didn't participate in that anywhere near as badly. So we've got about, I think 14 of these, the regional banks. I might be off on that number. I'll tell you when I bring the portfolio up here in a second. But anyway, we've got the regional banks that are part of the S&P 500. Now, I'm not looking at all regional banks, just like I didn't look at all money center banks. I'm looking at only those regional banks that are actually in the S&P 500. So the first one I want to start with is First Republic. Now, we've only got public information on this one going back to 2010, so this didn't participate in the financial crisis. But I do want you to notice a couple things, and I want to use this as an opportunity to kind of focus my FastGraph tool and how to use the tool effectively here. When you're using FastGraphs, you got to recognize that it's a dynamic tool. So when I look at this time frame that I've got posted here, which goes all the way back and lets me get the first day that this company publicly traded, I've got a growth rate of 8.69%. But a quick glance at the graph tells me that number is, if you will, contaminated by a 59% drop in earnings that we're showing from the starting date, and then 140% for the next year. So if I shorten that to one more year, now I've got a 17.818% growth rate. Now, when I'm using this longer term number, it is what people miss. They have to understand that the orange line, the fair valuation reference line, is going to adjust based on the growth rate that FastGraphs is recognizing. Now, anything under 15%, most of the time, if the growth gets real low, it'll be less. But most of the time, we're going to see a PE of around 15 times earnings like we do here. Okay, so, we're looking at an orange line. Anywhere I touch the orange line, it's a 15 PE. The blue line is simply the average market price, how the market has valued the stock over the time frame. It's, calculated here at about 19. But if I drop that one more year, now the growth rate is 17.18%. And now the orange line's got a PE of 17.18. These are valuation reference lines that you analyze. Now, this line actually probably looks a little closer to how the market's actually been valuing this stock. But watch again, this line has 140% growth rate factored into it down here. And so if I shorten this one more time, now I've got a growth rate of 10.38%. I'm back to that 15 PE ratio. So always check these color-coded boxes over here to make sure you know what multiples these lines are being drawn with, so that when you're doing your analysis, you can make rational, logical decisions about whether the stock's a good buy or not. Now, having said all of that, clearly this stock has all of a sudden separated from fair value. Now, I'm getting a lot of, comments, and this is not something new. This has happened to me. It happened to me during the irrational exuberant period back in 1998, 1999. Again, ladies and gentlemen, this is not my first rodeo. People say it's a new paradigm is what they were telling me back then. Today we're saying, we've got new technology and, the market doesn't, the valuations, we might want to readjust our PEs. Interest rates are real low. Let me explain to you what the essence of valuation is from my perspective. It's all about earnings yield. Okay, and earnings yield is going to be a function of how much money the company generates on your behalf. And what earnings yield is if the company paid you 100% of their profits, Okay, in the case of First Republic Bank, at this blended PE ratio of 29.05 that we see on the graph right here, then you've got an earnings yield of 3.44% and a dividend yield of only 0.45%. Now, if I use my dividend yield overlay here, you can see when this stock was attractively valued that, I had much better dividend yields, well over 1%. Again, this stock has a very low payout ratio, I want you to notice. Okay, so it's only paying out, 13 to say 15% of its earnings. So it's not a high yielding stock, but now the yield is actually below 0.5%. That's simply telling you that that's another way of telling you that the valuation is real high. And let me go back to the earnings yield now. That means if they gave you 100% of their profit, you'd earn 3.4%. Are you excited about an investment where the maximum amount of money that they could possibly give you as an investor would be 3.44%? All these people that say we ought to reset the PE ratios, the higher the PE ratio, the lower the earnings yield. Now, the only reason you should ever pay a very high PE ratio is if the forward earnings yield is going to be gargantuan. In other words, if the company's growing at 25 or 30% a year. But this regional bank is expected to grow at about 15% a year. Okay, which is very fast. So again, I'm using this normal or this rational PE, fair value PE of about 15, which would give me an earnings yield of 6.5 to 7%, not an earnings yield of only 3.5%, which is to me not acceptable relative to, what the amount of risk I'm taking to make this investment. That's what valuation is all about. There's this idea, and I did an article on this in a video where I said, I don't care what the company deserves, what valuation you think the company deserves. I care about what you get as a shareholder, owner of that company. And 3.5%, 3.44% is simply not enough yield, if you will, or return to get you attractive. Now, the same thing with CBR Group here. Once again, now I've got a 16.9% grower. So my orange line here, and for the time frame that I'm drawing here, my orange line is being drawn at a PE ratio of 16.9. It's being drawn at a PE ratio equal to the company's earnings growth rate here. All right, and it's a valuation reference. Now, even then, this company traded at a higher multiple than that several years ago. Now, watch what happens when I maximize this graph. When I send this thing out all the way I can, now my growth rate is down to 8.88%, and now the orange line has shifted to a 15 PE, but I now have this 22.26 line. And what you do with these lines is you look at them and say, okay, how did the price relate to those lines? That's really what this tool is all about. It's called a tool to think with. When you change the numbers change. Now I've got a 15.77 PE ratio here. But regardless, I'm looking at an earnings yield of 3.17%. That is simply unacceptable, especially now for a bank that doesn't even pay, income. This is actually a company in real estate services. It's not really a regional bank. Now here's PNC, one of the better banks out there. Notice the surge in growth that we saw in this company. But again, I've got a dividend yield here now of 2.57 and an earnings yield of 8.6. Now, I love that because that's much higher than my 6.5 to 7, but that's also because we had this surge of earnings of 49% in fiscal year 2020. Now, we're expected earnings to go back down to about 1147, but keep in mind that would be in line with what earnings were before we had this surge. Okay, so I'm looking at an earnings yield here of 8.6%, but I've got to really now worry about what my forward earnings yield would be. This is an analytical tool to think with. Now, when I look at this stock going forward, if I go back to that 15 PE, the minus growth rate that we're showing here is simply adding up all these numbers here. But what we're really talking about is growth of about 11% for 2022, 7% for 2023, and negative 32% for this year. So I just want you to make sure, those of you who are subscribers to this wonderful tool, that it is a tool to think with. It's an analytical tool. Now, in this case, I want you to also note that PNC trades at around 11.8, or an easy way to say that is more or less 11 or 12 times earnings. That's the normal value. When I draw this graph out longer, that changes to about a 13, and then I've got a 15 PE. But again, I want to make sure you're clear. I look at this graph and I say, okay, the company didn't trade at a 15 PE anytime at all from around 2009 up through actually up through current. It never got to that 15 PE, which is what this orange line is here on this graph with a 5% growth rate. Okay, so I'm looking at that and saying, what multiple would I want to put? Now, the 13 PE, which is the blue line at this time frame in this example, is a PE that it did trade at more commonly. However, there were also times coming out of the Great Recession where it traded at 10 and 9 multiples. Okay, so I'm learning from the past here and I'm evaluating that, but then my focus then turns to the future, and we're expecting a reversion to the normal earnings growth rate here, if you will, or normal, what I would call, transition of earnings. It's more aligned with what the company's innate earnings power is. For whatever reason, this was an anomaly, and I haven't researched it. My first question would be, why did we get this surge in earnings growth this particular year? So that's PNC Financial. Now here's Truist Financial, another case where here I've got earnings growth about 5.58%. And I've got both the normal PE and the orange line, both right at that 15 number, 15.6 on the blue line. And when I look at this graph, I can see that that's a good valuation. Now, obviously, by just looking at this graph and applying some common sense, if I can buy this stock when the PE is below 15, that's the best time to buy it. A 17 PE is a little high. The earnings yield of 5.75 is a little low, but the company is expected to grow pretty strongly going forward. So now when I look at forecasting and I look for, very clean forecast growth, I don't have any negative growth contaminating the math, if you will. I've got something here that might be very, very attractive. So this is one that I might suggest that you look at as a possible candidate for those of you who want to invest in a bank or looking for a 3% yield. The historical performance of this stock has been good. The dividend was cut during the Great Recession, but they've been increasing it at a pretty nice rate ever since. So I'm going to shorten this to about a 12-year graph and just look at it real quickly. And you can see the dividend growth has been really kind of nice here. This is still not totally functioning. This is a new version of Fast Graphs I'm using because I'm trying to showcase how quickly this graph works and how quickly it loads. The only reason why it's not out there right now is we very unfortunately had one of our key developers and his family come down with COVID, and he's working on some of these parts that aren't working now. We hopefully, his wife has recovered pretty much. He's going to be released from the hospital today or tomorrow, and then hopefully we'll have him back to work and we'll get back and having this product or this new version released. You're going to love this new version when we finally get it done. But let me go on. Here's Regions Financial. This is another really excellent little bank. And again, I'm going to adjust time frames here so that I get a more realistic look at the company. Good growth. They did have some COVID issues. I also want to make a comment about this. This is when the stock was really cheap. If we really wanted to be buying these regional banks, we should have been buying them about a year ago. That would have been the time to be buying them. I didn't. I'm going to admit that. But I've been kind of staying leery of the banks ever since the financial disaster. I do own, as I mentioned earlier, a few Canadian banks, but these stocks are recovering. The recoveries have been extraordinary. I mean, if you look just at this little bank here and look at, how fast it's recovered, it's up, it's more than doubled in value just in the last, year or so. So these stocks are really starting to get, come back into popularity. This one still has good earnings forecast, a huge year for this year, but then growth is going to kind of flatten out. And so as you're going further down the road here, that rate of return is going to diminish a little bit, but there's still a very attractive opportunity to invest in this stock even today. This would be Regions Financial. M&T Bank is another one of my favorites. I think this is a really excellent run little regional bank. When I look at the long-term graph here, I've got about 6.17%. Again, this idea that valuation doesn't matter and stocks ought to be higher PEs and all that stuff is nonsense. Look how the price follows the operating results of the company in this case. Obviously, the stock prices are always going to be volatile, people. There's no predictability. I did an article many years ago, and I said stock prices are pathological liars, and they are. And they're ethereal. They change with the whim of whatever people are thinking or believing. We get periods where you get very optimistic, and you get periods where they're very pessimistic. Pessimism, Warren Buffett, I think, said it so aptly. He said, fear and greed is what investing is all about. And he wanted to be greedy when others were fearful, i.e. down here, and he wanted to be fearful when others were greedy. That's what really makes sense if you're a long-term, prudent value investor. KeyBank is another good one. KeyBank did participate almost as much as the big money center banks during the financial debacle, which is listed right here in this gray shaded area. Since coming out of that, they've been performing pretty well. Growth has been averaging about 8%, a little bit of cyclicality. Once again, we see that they got really inexpensive during COVID. They're all recovering nicely. This stock, from a forecast point of view, looks attractive as a pretty decent rate of return. It's got a 3.5%, dividend yield right now. Now, I want to talk about earnings yield here. The earnings yield's about 7%, which is, clearly above my 6.5% to 7% number. So I like that. I think this is a real attractive regional bank right now, KeyCorp. The next one here is SVB Financial Group. This is another one that I believe has gotten extended now. It's become overvalued. If I open this graph up, you can see that, all of a sudden this valuation has gone absolutely crazy. Now, earnings are expected to actually be down this year, and yet look at the value that the market's putting on this. I don't know why. Maybe this is a buyout candidate. You'd have to dig. Again, I've not researched any of these thoroughly. I'm just simply showing you what the valuations look like with these regional banks of the S&P 500. I don't think this particular bank makes any sense right now. Forecast growth is only for about 5.5% or 6%, and the stock is trading at an extremely high valuation right now. So this would be one that I would probably suggest that you avoid. Again, I'm not really recommending any of these. I'm simply giving you or trying to give you a perspective of how they're valued. Here's Comerica. If you look at it, once again, you see the relationship of price to operating results. The market has put a pretty high valuation on this stock, but here, because the growth has been so low, note the growth rate is less than 1%. We're using the Graham-Dodd formula that was made famous by Ben Graham, and we're only drawing this orange line at a PE of 9.84. Always check the box to know what you're looking at. It's not always a 15, and it's not always the same whenever you draw a different time frame. So if I shorten this to a 9-year time frame, now all of a sudden I've got 6% growth, not the low growth I just showed you. Now I'm drawing the fair value at a 15 PE, and I tend to like the closer we get to to now, the more I like looking at these graphs. But I also like looking at them long term because it gives me a great deal of insight into what kind of company I'm looking at. Is it a great stock? Is it a very consistent stock? I like consistent growers, but I also like to buy consistent growers at attractive valuations. Huntington Bankshares is another one that got caught up in the financial debacle. Since the financial debacle, if I look at it for the last 10 years or so, this company's been growing at about 7%. Got an earnings yield of 5.4%. It's a tad pricey above the 15 PE, but it's expected a huge kind of reversion to the mean. In other words, we're going back into normal trend line earnings, or normal, what I would call innate earnings power here. That's why we're getting this big pop. But if I look at it going forward, earnings growth going forward is expected to be double digits. So it would be reasonably attractive possibly for the next year or two, with the stock just going back to a normal 15 PE. But it's all about this 1 year surge in growth here. I want you to don't just look at these charts and think above the orange line, below the orange line, or whatever. Analyze what you're looking at. That's one thing about this tool. It gives you so much information. And, what we say, it produces, essential fundamentals at a glance, and it organizes them so you can think about them intelligently and prudently. Here's People's United. This is another example. Let me go ahead and draw this out at the long-term graph. The market valued this stock extremely high. Earnings growth has been about 5.6%. It's, we've had this huge run up in price. It got hit pretty hard during COVID. It's now trading at a, reasonable multiple relative to what its future might be, but it's overvalued relative to what its current earnings are. And I think that's the key. So my earnings yield is just less than 3.97%. Here's Fifth Third Bancorp, again, one of the better banks out there, better regional banks out there. Been growing double-digit rates coming out since the Great Recession. They did suffer during COVID. Once again, here's where we should have been greedy when everybody else was fearful, and we should have bought these stocks, during the COVID crisis. That would have been the time to buy them. But keep in mind, human nature being what it is, guys, it's hard for us to buy a stock when we see earnings collapsing. That's just the reality of the way the world works. He is Zions Bancorp, another one that's, had a kind of an interesting long-term record. They participated in the financial debacle and got hurt very badly. Since coming out of the debacle, they've been kind of, moderately cyclical, growing at about 12% a year. I've got a 6% plus earnings yield, which is good. But again, I've got this huge recovery expecting, which is simply taking it back to what I would call its normal earnings power after suffering, some weak earnings as a result of COVID with a little bit of cyclicality expected forward. So, these banks are very attractive. They're interesting. Here's Citizens Financial. Once again, I want to adjust this because I've got bad data here. So I'm going to drop this to a 9-year graph, and now I've got a 12.5% grower, which is pretty realistic. If I look at the forecasting graph, it's expected to grow at 10 or 11%. It would be a decent stock, assuming that the, earnings growth that, we're expecting it to literally double its earnings this year. But once again, that's simply getting it back into alignment with its normal, pattern and innate earnings power. So the regional banks are interesting to look at right now. There's not a whole lot of value. There was a lot of value about a year ago. That's the time we should have been buying them. But I've been asked to cover the banking industry. So I thought one of the best ways to do that was to look at what the companies, the banks that make up the S&P 500. That was a way for me to do that. Most of these banks are actually priced better than the index, as I showed you a couple of videos ago. But again, most of the money, the opportunity, the margin of safety was about a year ago or, last March. It's not anymore. March of 2020, which of course was the throes of COVID, was the time to buy these. Anyway, I hope you enjoyed this. Hope you got a little better perspective of what regional banks look like today. That was all the objective of this video was about. It wasn't recommending or not recommending any of these companies. Please make sure you understand that. Thanks for watching. I appreciate it. If you really liked it, give me a like, a thumbs up, ring the bell, subscribe to the channel if you haven't already. It's Chuck Harnwell saying thanks for watching.